Picture this. You're sitting at your kitchen table in April, staring at your tax return, and for the first time in years, you're not mad. You're not stressed. You're actually smiling. Because the refund number at the bottom is bigger than you expected. Way bigger. Welcome to 2026. The tax code just got rewritten, and for once it's working in your favor. The one big beautiful bill passed, and buried in all those pages are 7 changes that could put real money back in your pocket. Not pennies. Real money. Money you earned. Money that used to go to the IRS. Money that's now staying with you. But here's the catch. The government isn't going to tell you about these changes. They're not going to send you a letter explaining how to pay less. That's on you. So let's break down all 7 changes right now. By the end, you'll know exactly what you qualify for and how much you could be saving. Change number 1, standard deduction increase. First up, the standard deduction just jumped. Single filers now get $16,100, up from $15,750 last year. Married couples filing jointly get $32,200. That's an extra $350 if you're single, $700 if you're married. Now, here's why this matters. The standard deduction is the chunk of your income the government doesn't even look at. It's shielded, tax-free. So if you make $50,000 and take the $16,100 standard deduction, only $33,900 is taxable. The higher this number goes, the less you pay. And the best part? This increases every single year now, automatically adjusted for inflation. So when prices go up, your deduction goes up too. No more silent tax increases where your income grows but your deduction stays frozen. That game is over. Every year you get to shield more income from taxes. It's automatic, it's permanent, and it adds up over time. Change number 2, child tax credit boost. Got kids? Then pay attention because this one's huge. The child tax credit is now $2,200 per kid, and it grows with inflation every year going forward. Before this, it was stuck at $2,000, and that extra $200 might not sound like much, but if you've got 3 kids, that's $600 more back in your pocket. Every year. And this isn't a deduction that reduces your taxable income. This is a credit. Dollar for dollar off your tax bill. So if you owe $5,000 in taxes and you've got 2 kids, that's $4,400 knocked right off. You now owe $600. Simple math. And here's the kicker. This credit is partially refundable. That means even if you don't owe taxes, you can still get money back. Up to $1,700 per kid. So low-income families benefit too. If your tax bill is $1,000 but you qualify for $4,400 in credits with 2 kids, you get $3,400 back. That's not a refund of what you paid. That's the government cutting you a check. But there is one new rule. Both you and your kid need valid Social Security numbers. Before, only the kid needed one. Now you both do. The government's tightening things up, making sure only citizens and legal residents get the credit. So if you don't have your paperwork sorted, get it done before tax season. Change number 3, senior deduction. If you're 65 or older, this is a game changer. On top of your standard deduction, you now get an extra $6,000. Just for being a senior. No forms, no hassle. You turn 65, you qualify. Let's do the math. Single senior gets the $16,100 standard deduction, plus the $6,000 senior bonus. That's $22,100 of income, completely tax-free. Married couple, both over 65, that's $32,200 plus $12,000. You're shielding $44,200 from taxes. If you're a retiree living on Social Security and a small pension, and your total income is under that amount, you owe 0 federal income tax. Nothing. This deduction is massive for people on fixed incomes. Every dollar they shield from taxes is a dollar they can use for healthcare, prescriptions, groceries, real needs. But there's a catch. It phases out if you make too much. Singles making over $75,000 start losing it. Married couples over $150,000 start losing it, and this deduction only runs through 2028. It's temporary, but while it's here, seniors are getting real relief. Change number 4. No tax on tips and overtime. This one's massive for service workers and hourly employees. If you work for tips, you can now deduct up to $25,000 of that income. If you work overtime, you can deduct up to $12,500 if you're single, $25,000 if you're married. These deductions run from 2025 through 2028. Think about what this means. A bartender making $35,000 in tips can deduct $25,000 of it. Only $10,000 is taxable. They just shielded 71% of their tips from federal income tax. Or a warehouse worker grinding overtime, making an extra $15,000 a year. They deduct $12,500 of it. Only $2,500 is taxable. They're keeping way more of what they earned. Now, this is a deduction, not an exemption. You're still paying Social Security and Medicare taxes on tips and overtime, but you're not paying federal income tax on most of it. Let's say you're a server in the 12% tax bracket, making $30,000 in tips. You deduct $25,000. That saves you $3,000 in federal income tax. If you're in the 22% bracket, it saves you $5,500. That's rent money, that's car payments, that's breathing room. But there are rules for tips. It has to be a job where tips were normal before 2025. Servers, bartenders, delivery drivers. If your employer suddenly starts calling part of your wage tips just to game the system, that doesn't count. For overtime, it has to be time and a half pay for hours over 40 a week under federal law. Not extra overtime from your union contract. Just the federally required overtime, and this is temporary. Only good through 2028. So if you're working tips or overtime, these next few years are your time to benefit. Take advantage while it lasts. Change number 5, SALT deduction. Quadrupled. If you live in a high-tax state, this is your win. The state and local tax deduction, SALT, just went from a $10,000 cap to a $40,000 cap. That's a $30,000 increase. SALT lets you deduct what you paid in state income taxes and property taxes on your federal return. So if you paid $15,000 in state taxes and $10,000 in property taxes, that's $25,000. Under the old rules, you could only deduct $10,000. The other $15,000 didn't count. Now you can deduct all $25,000. If you're in the 24% federal bracket, deducting that extra $15,000 saves you $3,600 in federal taxes. If you're in the 32% bracket, it saves you $4,800. That's real money. And if you're in places like California, New York, or New Jersey where taxes are brutal, this is enormous relief. But you only benefit if you itemize. Most people take the standard deduction because it's easier and usually bigger. But if you're a homeowner paying significant state taxes, mortgage interest, and making charitable donations, your itemized deductions might now beat the standard deduction. The math changed, so run the numbers. You might be surprised, and this increase is permanent. Change number 6. Tax brackets widened. Tax brackets just expanded, which means you can earn more money before jumping to the next tax rate. The 10% and 12% brackets grew by about 4%. The higher brackets grew by about 2.3%. What does this mean? Let's say last year you were right at the edge of the 12% bracket. This year, that bracket is wider. You can earn more and stay at 12% instead of jumping to 22%. Same income as last year, you might owe less tax because the brackets expanded. This protects you from bracket creep. That's when inflation pushes your income into higher tax brackets, even though you're not really making more money. Your salary goes up 3% to match inflation, but suddenly you're paying a higher tax rate. That's not fair. Now, the brackets adjust for inflation automatically, so your real income can stay the same without getting hit with higher tax rates. For most people, this saves a few $100s a year. Not huge, but it's money you weren't saving before, and it happens automatically every year. The brackets will keep expanding, giving you more room before you hit those higher rates. Change number 7, Trump accounts for kids. Last one, and it's wild. Starting in 2026, the government is creating Trump accounts. These are tax advantage savings accounts for kids. And here's the best part. The government deposits $1,000 into the account for every child born between 2025 and 2028. Free money from the government, no strings attached. After that initial $1,000, you can contribute up to $5,000 a year. Parents, grandparents, anyone can contribute. Employers can chip in up to $2,500 per year tax-free. The money gets invested in low-cost stock index funds and it grows tax-deferred. You don't pay taxes on the gains as long as it stays in the account. Your kid can't touch this money until they turn 18. It's locked away. When they hit 18, the account converts to a traditional IRA. At that point, they control it. They can use it for college, a house, starting a business, or just let it keep growing for retirement. Let's run the numbers. You have a baby in 2026. The government deposits $1,000. You contribute $5,000 a year for 18 years. Assuming a 6% annual return, by the time your kid turns 18, that account could be worth around $180,000. You put in about $91,000. The rest is growth. And it all started with a free $1,000 from the government. But contributions aren't tax deductible until your kid turns 18. So you're using after-tax money. It's not like a traditional IRA where you get an immediate tax break, but the growth is tax deferred, which is still powerful. And there are income limits. If you make over $200,000 as a single filer or $400,000 as a couple, you can't contribute. But your kid still gets that initial $1,000. This program only runs through 2028 for kids born in that window. So if you're planning to have kids, this is a real incentive. That $1,000 deposit plus the ability to contribute tax advantage money for 18 years is a significant benefit. It's not going to pay for your kid's entire future, but it's a serious head start. So there you have it. 7 tax changes in 2026 that could put real money back in your pocket. Bigger standard deductions, higher child tax credits, a senior bonus, relief on tips and overtime, a massive SALT increase, wider tax brackets, and free money for your kids. These aren't small tweaks buried in the tax code. These are real changes that affect real people. Whether you're a server hustling for tips, a family with kids, a senior on a fixed income, or a homeowner in a high-tax state, there's something here for you. But here's the deal. These benefits don't appear automatically. You have to know they exist. You have to claim them. Some are automatic, like the standard deduction and wider brackets. Others require action. You need to track your tips and overtime. You need to open a Trump account. You need to see if itemizing beats the standard deduction now. The government isn't going to tell you how to pay less. That's on you. So get familiar with these changes. Talk to a tax professional. Use updated tax software. Run the numbers, but don't leave money on the table. And remember, some of these changes are temporary. Tips and overtime relief ends in 2028. The senior deduction ends in 2028. Trump accounts are only for kids born in a 4-year window, so take advantage while you can. The tax game just changed, and for once you might actually come out ahead. Now go get your money.